All right, good afternoon, everybody. My name is Troy Tucker. I'm with Blue Sky Business Resources. We're an M&A firm, investment banking. We do a lot of consulting service. We are pleased to have with us today Keenan McCollom from Now CFO and Caitlin Bradshaw. We also have Amy LaSala, who's going to help me if I run askew. Keenan does capital raises for Now CFO. He's been doing this for a long time. He had a run as an investment banker and then working for private equity. He's very familiar with helping companies raise capital in first round, second round, A and B, according to the things I saw. Keenan, it's my pleasure to welcome you. Thank you so much for doing this. We do want this to be very interactive, if you will. So if you have questions, please put them in the Q&A function. I will be monitoring that, and we'll bring those to Keenan's attention when it's appropriate. With that, Keenan, I'm going to turn the time over to you, and hopefully I will be able to have a great webinar today. Thank you very much for your time.
Awesome. Thanks, Troy. I appreciate that intro there. Hey, everybody. Thank you so much for joining. Really excited to dig in a little bit here. What I wanted to do, I'll just go over the agenda here real briefly, and then we can kind of dig into some of the material. So, we've been getting a lot of questions as we're out raising capital, just around the general market environment, what's going on, our investors investing, things like that. So I wanted to cover some data around just the general VC markets. It was put together through some research and interviews with about 500 VCs. We can get into that a bit, but then also wanted to cover a little bit about how we're raising capital, what it is that you really need to do now, especially because of this environment we're in, and really how to kind of build out a capital raise so that you can leverage multiple term sheets off of each other, not only to bump up valuation and interest, but also to continue to move investors down the pipeline and really be able to apply some pressure to get a deal closed. So with that, Troy did a good job on my background. I've been doing some investment banking, private equity stuff in my past, and then started with Now CFO about 2 years ago. We really focus in my practice on helping companies, I'd say from Series A or B and later, with their capital raise. So whether it be, a $1 or $2 million type of round where a company is doing a little bit in revenue, we can come in, help out with investor decks, really detailed financial models, and then really the strategy. So kind of fit and focus of your deal in the capital markets is really something that we like to work on. So again, it's the Series A and B, but we will help with pre-seed, and the way that we can work is somewhat a la carte. So it allows us to be really flexible. The main focus is really kind of the deals in the market that the traditional investment banks really don't want, whether it's because it takes a little bit too much creativity or it's a little bit too small. So that's really our sweet spot. We've been doing deals all over the country. Kind of funny because even before the quarantine, we've been working remotely with some clients. We closed a Series B out in Florida with a CEO that I actually had never met in person, which was a pretty interesting experience. But due to the quarantine, we really haven't slowed down much at all since we were already built for remote work. So that's been nice. All right, so digging in here, this is just a little bit of background on some of the data. So I want you to keep in mind, a lot of the VCs and investors that were interviewed for this were early, say, seed to Series B focused, and then fund sizes. So the current vintage, not total assets under management, but current vintage fund was about less than 150 million. So it's not the huge groups, it's not the Carlyles or the Andreessen Horowitz, but to the point of out of the Bay Area and really good quality investors, this is some amazing data. So let's just jump in here. One of the main things that we get asked about, I would say, is, are investors still investing? When the quarantine started to happen, I guess in April, May, kind of whenever that was, a lot of the feedback that we were getting was, as the investor, they were really insulating. They were looking internal to their portfolio, making sure that their portfolio companies were really bolstered down, ready to weather the storm. And they were reinvesting in some of those companies, providing some more cash runway and allowing those businesses to kind of go through this rough patch. We're through that now. A lot of investors, we haven't heard that anybody say that in the last couple months. Everybody is kind of back out looking for new deal flow. With that being said, a lot of investment firms have retargeted their volume targets downward so that, you know, they're not going to be doing as many deals this year. And the deals that they do will probably be at a bit of a higher bar. So they're setting the bar a little bit higher. The data here that's interesting to me is right in the middle. So if you look on the bookends here, the 6+ and then the 0, both of those have changed, I guess I would say, a little bit for the worse. The projections on doing 6+ has come down in 2020. And then some of the projections for not doing a single deal actually has gone up a bit. You can see the 1 to 2 has gone up for these early stage type of groups. So, you know, that's more where they're looking, again, communicating that the bar is kind of going to be raised. We will still do deals, but it really has to be a good fit, and we have to be really convinced here. So, you know, just a little bit of interest on volume, but something that we also get asked is, what's the valuation impact here? In the beginning of the quarantine, a lot of groups were really expecting there to be the 20 to 30% valuation impact. I've been talking to a lot of folks recently, and interestingly enough, they're communicating that they expect deals that are somewhat, call it recession-proof or COVID-proof. So if you think SaaS deals that aren't related to in-person events, or if you're enabling companies to go virtual, we have a client right now that is, call it an e-learning SaaS company, and really related to the virtual events world. They have absolutely exploded. They'll probably double their revenue this year over last year. And that's because they just by happenstance were positioned to actually do pretty well through this. So those kinds of companies, we're actually seeing a valuation premium. However, throughout, you know, kind of a broad stroke, we are expecting about the 20 to 30% valuation impact there. You know, I think it really depends on how you run a process. If you're able to get multiple offers close to the end of your process, you know, should still be able to push for a pretty good valuation. We were high as it was, so it's not like we're coming off of kind of a standard valuation environment as it was anyways. But something that we do need to kind of anticipate. Something else I would throw out is for sort of the pre-seed and maybe early Series A type of deals, those are a little bit more of an art as opposed to a science on valuation. So those don't expect to kind of experience this full hit. It's a little bit more of the later stage deals where maybe revenue is slowed, growth is slowed a little bit, and there's more of a typical kind of valuation metric assigned to it. So those ones will, I think, take the hit. But overall, you know, just kind of depending on a case-by-case basis. So this is a really interesting point to discuss because obviously as we're going through this situation, runway is extremely important, right? So as the investors were reinvesting in their portfolio companies in the beginning of the shutdown, they're actually, as I said, bolstering them and providing for about a 70% ratio here where 70% of portfolios actually have a year or more of cash runway right now. Part of that is due to the reinvestment. Part of it is really due to companies kind of tightening up expenses. Obviously, we're not traveling as much and really learning how to stretch their balance sheet. So I think for any of you out there that are in a similar situation, being able to tighten up is going to be really important, as I'm sure you've already experienced. But it's good to see that, you know, this is kind of a standard philosophy across different kinds of VC funds. So, Troy, I don't know if there's anything you wanted to cover. We can dig in here on some of the data that's actually leading to these changes in the market right now, if there's no questions here going forward.
I didn't see any questions. I think you got a good flow and rhythm going on, Keenan. Why don't you just kind of keep at it, sir?
Sure. So as maybe some of you know, maybe some of you don't, really the way that investment funds are structured is there's actually the limited partners in funds, whether it be a VC, private equity, there's all kinds of different styles of funds, but they're really the drivers of what the investors are doing. So as you think about how an investor is investing, and if they're throttling down on their volume or they're adjusting valuation expectations, a lot of it is driven by their internal situation. So as investors are going back out to raise more funds, for example, we are beginning to see that some of them are targeting a lower amount. This here is describing the reserves that they want to hold in their own fund in dry powder for their portfolio companies. So really, it's kind of interesting here to see that only 18% are really adjusting that number. I think a lot of that is due to a lot of that reserve capital already being deployed early on in the shutdown. So this is good because this here tells us that there's still plenty of dry powder to go into the market, and a lot of funds are not really pulling capital out. They're still looking for new equity to be investing in. Bolted onto that are new fundraising activities, right? So if there's a fund that's kind of going through, call it their second vintage, they need to go out and raise another fund. 37% have actually modified their target downward. So that's something slightly concerning. Probably we won't see the impact of that for at least 12 months. I would say to 12 to 18, depending on where they're at in their fundraise. The reason for that is because the current dry powder state is so high that future fundraises will not impact us, at least for the time being. They will eventually, because that's what's going to turn into the dry powder. But for now, again, it's groups are looking to put capital to work, and it's really just being a little bit more picky, taking a little bit longer time. To the point of dry powder, this graph here on the left, you can see, sure.
Someone asked if you guys do valuation work yourself. I mean, it's something that Blue Sky does. Is that something you guys do? You talked about, the VCs were reducing the valuations.
Yeah.
My feeling is they're reducing it based on the amount of money they want to put in, and they're also really concerned about the economy. Is that your sentiment? And does now CFO do valuation work, or is that something that you put out to somebody else?
Yeah, so we will do a little bit. By that, if there's a situation where, for example, a discounted cash flow model makes a lot of sense, we can certainly produce something like that to get a sense. We don't do an official valuation report. We're certainly not a valuation firm. For that, we have partners, and you guys are extremely good at producing a full report where we're doing comparable analysis, maybe a little bit of precedent transaction type of stuff from public markets, things like that. What we try to do is guide by deals that we're seeing in the market and give that baseline. So, for example, we just closed a deal at, call it 6 times recurring revenue. So if there's another deal in a similar kind of industry or business model, we're getting those data points, and we're just seeing so many deals coming through, both from the investors that we're speaking with, but also just from deal flow that, we try to kind of steer the ship that way. And then again, if a client wants a full-blown valuation report, that's something that we would work with you guys on.
Okay, awesome. I know that Amy sent me an article just the other day about EBITDA with COVID implications attached to it, and actually making add backs for COVID adjustments, which is pretty interesting.
Yeah, we're seeing that. So we don't do a whole lot of full buyout deals, but I see a lot of them and have friends in private equity, and I've been talking to quite a few of them recently, and COVID adjusted EBITDA is actually something that people are looking at, both, I'd say COVID adjusted revenue as well. If the revenue trend line was really accelerating and then going into, call it March and April, it dipped down, the sense is that a lot of groups are actually just kind of saying, okay, well, if it wasn't for COVID, this is the line that we would have been on, maybe getting a little bit more comfortable with slightly larger check. But, again, kind of depends on a deal by deal basis.
Absolutely. So do you think that's going to equate to, hey, we're just going to not look at this year? I mean, do you see that kind of moving forward, or if it's a one-time blip, I mean, it's something that should be swept under the rug, kind of in a way to think about it? Yeah.
So I think it depends on how the company has responded. So we did a panel with a private equity group, a really large growth equity group that doesn't look at anything under 20 million in revenue, and then a smaller but kind of fast-paced growth equity group. And each of them are still very much paying attention to how companies are performing during the lockdown. I think they're probably not assigning metrics and maybe performing a typical underwriting process on those numbers specifically, but it is leading them to interest. So, for example, if a company has been doing really well, then that's something that is going to catch their attention. If a company has been able to kind of continue to plug along, but understandably growth has not continued to increase, but margins are still pretty good, I think they're just thinking about it differently, but certainly not just crossing 2020 off in general, just because it threw a couple wrenches in the engine.
Very good. Yeah, as far as, so Keenan was saying that they'll do some DCF analysis. Our standard valuation has discounted cash flow analysis in it. And if you have questions about that, get a hold of Lance or Amy or myself, and we can give you what that really means if you want the entire breakdown. Lance, thank you for running off into the weeds with me for a minute there. I appreciate it.
Yeah, of course. Thanks, Troy. So yeah, jumping back here, these are some pretty interesting stats just from where we were kind of pre-COVID in 2019, extremely high dry powder numbers. Again, just communicating that, hey, investors do need to put capital to work. That is their job, right? So they're managing this money and they don't want to have to return it if they can't put it to work. So they are still out looking for good deals. And I do think that this is going to hold us over for the next 12 to 18 months or so. Just kind of given the volume decrease and things like that. A couple interesting things that I've been hearing from some investors, just kind of generally getting comfortable with Zoom and, really the way that the world is working now. So it's been a good time, really. It's very encouraging. And I think, if you are building an interesting business, if you do have growing revenue, this is still a good time to raise capital. Valuation is going to be the concern with anybody, as well as timing on close. But I think it's certainly nothing that you can't get around. And we've closed a seed round, $2 million seed round right at the height of the quarantine. It was actually cash in. Just got another deal signed up on a term sheet and closed another debt round. So there's plenty of activity. This to me is one of the most encouraging data points that I wanted to discuss today. This is saying that almost 70% of these investors interviewed are actually comfortable investing a significant amount of capital without ever meeting in person. I never thought that would be the case. It was completely shocking. And I can back this up just with anecdotal evidence with people I'm speaking with, where it's, hey, we can't really travel. Maybe it makes it a little bit more difficult to do a deal if it's across the country, but groups are investing without meeting in person. I will say, from my experience, commercial banks are a much different story. They're still very hesitant. We had a really interesting deal that was out in New York. Perfect fit for a very large bank. I was talking to the local group here in San Diego. They wanted the deal when they found out it was in New York. It was not something they could do. Unfortunately, their New York office was also not really built to take this deal on. So I would say that debt could be a little bit different. However, the VC and private equity groups are very, very comfortable right now, fully operating over video conference and Zoom. So very encouraging there.
That's pretty interesting.
I
said that's pretty interesting. I guess we've all gotten used to Zoom finally.
Well, unfortunately, I have to wear these blue light glasses because staring at my screen for 10 hours a day just fries my eyeballs out my skull. But other than that, it's definitely nice, having that face-to-face is I prefer over a phone call. So certainly I am getting used to it now. But so a couple things, it's one thing to kind of go through where the market is, what investors are doing, and, that's all interesting. But the question really becomes, how do we adapt? What do we need to do to raise capital in general, right? But also, more importantly, right now, since it's such an odd time, and how can we increase our chances of that? So one thing that I wanted to do was just quickly run through a bit about how we think about cap raise, especially right now in COVID. And a little bit about process. So again, a lot of entrepreneurs come to me and say, hey, I've been talking to investors. My friend's a lawyer. He has a couple of investor clients. So we talked to them, and then we got a couple other intros. The process that we like to run is a much more sophisticated kind of proactive approach. Again, very similar to investment banking, where we are actually taking a step back before we take multiple steps forward. Because in my opinion, preparation is extremely, extremely important, and it's never been more important than right now. Before we dig into that stuff, I want to throw out a couple quick ideas here and some things that we've been seeing some clients find interest in. Before activity popped back up to a pretty good level, groups were having to get a little bit more creative to finance their companies. One way that we've been seeing actually a lot of success is going out and performing a roll-up. Here's an example. We have a client that is a hospice company growing like a weed. They should do about 10 million or so in revenue this year, probably 2.5 or 3 of EBITDA. So they've only been around for, call it 18 months. Good metrics, not necessarily something that's going to get a lot of larger private equity groups interested, but definitely a market for it. What they wanted to go do is take advantage and leverage this current situation to go acquire a couple other businesses and actually underwrite off of the combined financials. So if you're in a situation where, hey, revenue is not that high, we want to either sell a minority or a majority of the business because we need cash, maybe going out and kind of expanding right now could be a good way to do that. Another way we've been seeing people get creative is to actually become more tech-enabled right now. So they're going out and, if they are tech-enabled, acquiring businesses that are not and experiencing some of that, call it valuation arbitrage right there, by pulling revenue and EBITDA that was not tech-enabled into a tech-enabled environment and having that bump up of valuation. But also investing in some technology in the business right now. There's a large ticket broker company that I was talking to yesterday. They were doing $250 million of revenue, on pace for that in 2020, and went down to zero because there's no events. They were already pretty tech heavy. However, they're saying, hey, we have multiple millions on the balance sheet right now. What should we do with this? And they're reinvesting and trying to come out of this thing in a better situation than they went in. So some things to think about. Obviously, I don't know the situation that you all are in, but certainly something that I've been seeing a lot more of, and I really like the way people are thinking about their business in this regard. So back to the preparation and kind of taking that step back. For us, when we begin to think about raising capital for a client, it really is, what is our go-to-market strategy and where is the deal a fit? After you understand what the buyer is trying to buy, you know how to sell it to them because they are pretty upfront about it. So really finding who the ideal buyer is and not being afraid to reach out and kind of create a list, to me, is key. Obviously, having the correct marketing materials and a very well put together investor presentation that not only creates the intrigue and interest, but also substantiates it with traction and some other things that will answer red flags with the context that you provide, as opposed to letting the investor create a scenario on their own, is extremely important. Right now, a bottoms-up financial model, I think, is probably one of the most key pieces of collateral to have, because it describes your business not only detailed, but in the context the investor wants to see, and gives them the numbers that they're really digging through more so now than ever due to COVID. People are really going through the financials and trying to understand different scenarios and mapping those scenarios based on, hey, what if this pandemic continues the rest of the year? What's this business going to do? What if we return? What if there's another one next year? So having that kind of a tool is key. And then process. So again, making sure that we are kind of being proactive in our outreach. I will get more into that here in a second, but let's just go through this list in a little bit more detail. So when we think about the market fit, there's a couple things that should come up immediately. Believe it or not, geography can be very important. There's plenty of groups that will not invest if it's not in their geographical focus. So for example, some groups will only do east of the Mississippi. We closed a Series B that went in Florida with a group that was only in Georgia and Florida. So understanding, again, where you're going to fit is key geographically. Check size. If we're raising 5 million, we need to go to groups that will actually write checks for 5 million. Ideally, they're looking for, say, 2 to 7 million. You're kind of in the middle. When you're going to have a little bit more of an issue is when they will write 5 to 20. They will usually want to put more capital to work. So if you're at the very low end, you're going to have to be a really good fit on everything else. You're going to have to get them interested. They're going to have to love the industry, your revenue growth, structure of the business, the team, because it's a little bit more of a difficult sell for them to their investment committee and in some cases their LPs if you're on the lower end of their check size focus. Revenue should be pretty obvious. You know, a group that's looking for a company doing at least 5 million in revenue, that's a pretty tough one to get around. So really try not to waste time on groups if you don't know what they're looking for revenue, as well as industry growth profiles, things like that. And then one thing that is not as obvious, but something that I think is extremely important, if not one of the most important points, is what do you look and feel like? So what is your maturity level? If you're, for example, doing 2 million in revenue, perhaps you can go to a Series A group. However, if you don't have a repeatable process for your sales team, if the team is not built out, if you haven't gone through some of the typical things that investors want to see, you might not be a fit for a Series A. The seed round that we did was this exact situation. They're doing about 2 million in ARR, growing like crazy, but just didn't have this repeatable sales process. And when we were talking to Series A true VCs, they loved everything about the business, but could not get over the fact that there was just too much risk in not really business model, but in business execution. So do an audit of that on your business. Really try to understand how mature you are from sales, from product market fit, all of those things. And then that will really help to lead you and guide you into who the right investors are. Because once you understand who those investors are going to be, then you can just block and tackle, right? So the financial model, again, extremely important for execution, because if you have a revenue model, what we see a lot of is a company saying, we did $1 million last year, we're going to grow 10% a month. They think that's a great assumption to have, and you know, a quote unquote dynamic model, because they can go in and change it from 10 to 12 or 15% revenue growth. What we need to be able to do is describe how you get a customer, what happens to that customer, and what kind of expenses are related to that. Then convert that over to revenue. So that's the way that I want you to think about this, where, for example, if you're an app company and it's purely driven on digital marketing sales, what we need to have is a monthly digital marketing expense that you can adjust. Then run that through a funnel. So cost per click gets you to visitors on the site. Visitors on the site, we can convert to, call it a download. Then download, maybe there's a percentage that will never use it. But you can have assumption there that says daily or monthly active user, and then track that through churn. What that allows you to do is have a much more fundamental conversation with an investor or anybody. And instead of arguing, well, I don't think you're going to grow 10%, I think you're going to grow 5%. Here you can say, well, it's really based, for the most part, off of historical data through this funnel. We know that we can do 80 cents cost per click on Facebook and $1 cost per click on Google, whatever. You have those channels listed out, and you already know the conversion metrics, or you can base it off of industry standard type of numbers. That's a much better conversation to have, and something that's going to pretty quickly get rid of a lot of red flags and just increase your chances of closing with every single investor you speak with. So certainly something that I highly recommend is getting a true bottoms-up financial model. And then very importantly is process. So once we've understood the deal fit in the market, we understand who our investor is, how to get in front of them, and then once we get in front of them, what to say, now we can run a process and kind of batch outreach. A lot of people are hesitant to perform cold outreach. I'm a huge proponent of it. We have really good success on it. Yes, it's kind of easier to get in front of groups and get a response from groups when you already know them, but at some point you're going to have to get it cold, right? Or else how are you going to meet them? So if you can get the warm intros, fantastic. If not, you can find emails online. You can find the associate, senior associate, or principal on websites to reach out to, and just kind of get out there, do the ground and pound, and get in front of them. what I want you to do from managing your investor pipeline is to batch it in a couple outreach, call it days, where you're doing 20, 30, 40 outreaches in a day. And then what you need to do is kind of move them forward in, call it categories or vintages. So the goal there is to have a lot of groups performing introduction calls. Then you want to move as many of those as you can to the next step and say it's an NDA, or say it's kind of the management discussion after they've gone back, the investor's gone back and had their internal investment committee meeting. And then what you're going to start to see is instead of kind of herding cats in a way where you have one investor ready to sign up on a term sheet, you're having introductory calls with a couple more that you were just introduced to, you're batching them all in categories down this pipeline with the goal of keeping everybody in a kind of tight from a timing perspective. And when you're ready for term sheets, now hopefully you've done a good job and it's a good deal and people are interested, you can actually apply some pressure to get different investors to issue term sheets because, one, you have other people waiting that were all timed accordingly. Maybe you already have some term sheets and you're saying, hey, we might as well try to get some more. Let's go apply pressure to these guys. If they drop off, we don't care because we have another 3 or 4 that are still interested. Easier said than done. Every deal is different. The deals that aren't, necessarily great deals in the market, those ones will struggle a little bit more, but that's kind of an ideal situation where, again, you don't want people running too far ahead. So what we typically will do is be kind of that third party umpire where we slow groups down in certain cases. Obviously, there's cases where, the company needs the capital in as soon as possible or immediately. But if a group gets too far out in front of the pack, we've got to rein them back in because we don't want them throwing the entire process off. So again, very proactive, be very coordinated, keep a CRM, understand where you're at in the process with each investor, and just stay as detailed as you can. I think, kind of matching this ideology and process along with the correct preparation, the correct investor fit and profile is really, really going to give you the best chance to close your round. And, this is becoming more and more necessary during the lockdown, mostly because having this, quote unquote unicorn opportunity where if you could have thrown the idea around to a couple folks a year or 2 ago and it would have got closed, it's just not happening as much anymore. You have to really take a strong approach and be organized in your process.
Keenan.
So with that, yeah.
You were talking about, how you go through and you're talking to the investors and stuff like that. I know when we've got a transaction that we're running, we'll typically start with the groups that we feel are least likely to move forward with it. And we do that on purpose so that we can hone our information because we're really looking for the feedback. And that way we can improve our pitch on those that are least likely to move forward anyway. And so it's less painful basically, right, at the long run, because you need to improve that pitch. And this is a great way to get experienced eyes on what you're trying to do and learn from their experience and knowledge.
Yeah, I agree. We do the same thing. And guys, to Troy's point, really what it allows you to do is see around the corner on the pitches that matter. You already have the questions answered because in general, a lot of investors are going to be asking very similar questions. So you know how they're going to be thinking about your deal. And when you kind of burn those turns on the groups that maybe aren't the best fit anyways, it really gives you a really good chance with the groups where hey, we fit what they want to see in all of the boxes. So Troy, thanks for that. That's a really good point.
Yeah, so if any of you are thinking you want to do your own instead of calling a professional like Keenan to have them help you out, these are just words of wisdom right here, and you should put those in your notebook, underline them, highlight them, whatever you got to do. Thank you, Keenan. Yeah, absolutely. So guys, I think that's just about wraps it up for what I wanted to at least kind of present and talk about today. A couple key takeaways here is, the market is still here. It is a little bit slower and really focused on high quality premium type of deals. And oddly enough,
investors are comfortable with investing completely remote. So very encouraging signs. It's certainly something that I love to see. We're still extremely active. We're kicking off a new deal tomorrow, so companies are definitely still out raising and getting a lot of activity. So if that's the situation you're in, don't hesitate to reach out to us or Troy. And, if nothing else, happy to just kind of chat through ideas and see where you're at, and try to get you on a really strong footing as you prepare for your cap raise.
Yeah, absolutely. I think this has been some great information, Keenan. I appreciate your time for sure. I want to kind of go back to the valuations, if we could, for just a minute, and talk about where you've seen what industries maybe are taking the biggest hits, and where. I mean, I know standard industries where people are just not investing. Travel, leisure, event space, that kind of stuff. But what other industries are kind of maybe getting hit that you wouldn't suspect are being hit?
Yeah, so you kind of hit it on the head. Originally, I was thinking, the event space is an obvious one. We have one of those clients I mentioned earlier has an investor and board member that's a $3 billion events company, and they've furloughed almost, I'd say 80% of their staff, if not more. So really the things that I've seen it take just gone to zero, at least from a valuation or an interest perspective, are the ones that rely on person-to-person interaction, and kind of that touch contact world. The experiential world is difficult if they haven't adjusted to virtual or kind of tech platform. So that's certainly something. But in general, I mean, we see a lot of technology type of stuff that really is still looking pretty good. Consumer is a little bit iffy. I think if you have an idea in the consumer space right now, and maybe not revenue or growth to kind of back it up, that's tough simply because of the economy. But, overall from what we're seeing, people are really figuring out a way to kind of press through. So that's been really, really good.
Mm-hmm. I was talking with a gentleman who has a travel agency, and he's dropped 90% of his revenue.
Yeah, I believe it.
It was just brutal, and he was going really well, and all of a sudden, 90% of the revenue is gone. It's painful. When is the best time to, if you're thinking about raising capital, when should you start doing that? I mean, how far along, Keenan, or what stage of maturity? I mean, I realize there's different investors that invest at all kinds of different stages, but what's your thoughts on that?
So in general, I would say prepare as early as you can. If you think you want to go out and raise capital this year, start now. Start at least preparing. It's never too early to form relationships with investors. So I would also say that. And if you can get people to begin tracking you, for example. So a lot of times, if you're a little bit too early for an investment, like a venture capital Series A or B, they are going to want to keep in touch because they want the deal flow, but also want to watch you grow. So if you understand that, and if back when we could go out and network and meet people in person, if you're able to form those relationships, keep in touch, send out a newsletter just to kind of stay top of mind with groups, that is always something good to do. I would say the majority of the groups that reach out to us, the best time is probably, again, when you're beginning to think about it and you need to prepare. We typically would say it's going to be at least a month or so, unless you already know exactly what you want. But about a month or so to prepare, get all the materials ready and strategy together. So that puts you out 30 days immediately. And then capital in from there. I mean, I don't know, Troy, if you see anything different. I would say it's at least an additional 4 or 5 months kind of situation. So, that's generally about 6 months is about the fastest that I'm going to see an institutional deal get done.
Yeah. I can see that happening for sure. What do you think? I was talking to the travel agency here this week and last week. And one of them was interesting. He wanted to go out and purchase companies and make acquisitions because he realizes a lot of them are going to go away. He's going to be able to make some great deals. I think that's a very strategic thought. That makes a lot of sense to me. One of the things I asked him is, hey, when do you think that people get back to normal and start traveling again, and what does that look like? And I know stories of people that are buying cruise ships and all that stuff because they're all on sale, they're really cheap. And his thought was, probably halfway through next year before that industry actually starts turning around. What do you think? Yeah. When do you anticipate we'll get back to normal? And is there going to be a new normal, or can we get back to life as usual?
Yeah, it's a tough one. I mean, I don't think it will be life as we knew it before. I think that's almost a guarantee. We're going to have to adapt. And regardless of, what happens with the actual COVID-19 virus, it could completely be extinguished tomorrow, but this experience has and will continue to change people and the way that they think about business, the economy in general, and their risk profiles. From a timing perspective, I can't see a whole lot of large in-person events or cruises, like you said, happening this year. I mean, that's just really tough. Hopefully sometime next year that will get going again, but we're already halfway through July. And the first wave, quote unquote, still isn't done. People were kind of preparing for the second wave in fall, but if we can even kind of extinguish this for the first wave, we're never going to even get into the second one. So my concern from the beginning has always been kind of this slow, drawn out bleed out where, some people are complying with whatever the requests are with the stay-at-home orders versus just a really maybe painful but shorter timeline on 4 to 6 weeks kind of thing. That's kind of what we're seeing. Here in California, I think it was Monday, a bunch of businesses just had to close back down. So if we continue in that cycle, at some point we're going to have to figure out how to live with this if it doesn't disappear. So it's kind of scary, but at the same time, a lot of companies have already learned how to survive and also in some cases thrive through this. So, that's right. Somewhat encouraging, and we're just going to have to adapt just like any time else. Yeah.
John Carter asked a good question here. What is preferred for seed round, preferred or convertible debt?
So I typically advise for convertible debt. I'm not sure preferred debt. I would have to see what you mean by that. But typically, like if you're on a convertible note, sometimes a safe is okay. But really, I prefer convertible note if you're pre-revenue. And if you are, I would even say like under $500,000 to $1 million in revenue, just so you don't have to truly put a valuation on there. If you do a cap, that's kind of a pseudo valuation, but it doesn't really have some of the implications that a full equity round would. So yeah, if you're seed to pre-seed, I would certainly say push for convertible note, especially if you're doing angels or individual investors. A little bit more difficult with institutionals. The institutional seed, I would call them, a lot of times want equity, but we see plenty that are comfortable in convertible debt. So, that's certainly what I would push for.
Absolutely. And debt is so much cheaper than equity at any given stage, really. I mean, if you give up even if you have to take money at 10%, that's still far cheaper than giving up 25 or 30 or 40% of your company or whatever that requirement is for that kind of money. So that's and John was talking about stock too. He wasn't really talking about, so he was talking about a stock position.
Got it. Okay. That's what I figured.
Yeah, that's what I was thinking too. So, do you think the deal activity is going to go up next year? I mean, I know we looked at that slide. What is the forecast for next year?
I think the quality of deals is going to have to improve, and probably the preparation and presentation of deals. Again, there's still plenty of deals getting done, but there's not as many stretches. So assuming deal quality is still good, And by that, I just mean kind of fit, not even necessarily revenue numbers, but, again, because there's a buyer for everything. So if it's a distressed opportunity, there's distressed buyers. I think they might increase their volume, the distressed groups that are kind of looking for the companies that may have struggled during COVID, trying to do more of a value buy. Mm-hmm. So I certainly don't think volume or valuations is going to return to, say, 2019 numbers necessarily, but absolutely something that will most likely be driven by the founders and the owners. If they're comfortable with their valuation projections, I think a lot are going to want to be raising capital or selling. And again, the dry powder's there, the investors are there. So it's going to be somewhat of a function of, in my opinion, sellers as opposed to buyers.
There's some that think there's going to be a deluge of deals as things calm down. Yep. Owners accelerating their timeline to sell. You got any insight into that? I mean, I know that PE has massive capital sitting there, dry capital. Yep. So does VC. I mean, I think they're a little more particular, but I think they've always been particular.
Yeah. So that's something that I think about almost daily, and I hear different feedback from different folks. So it's difficult to really pin it down. My sense is that I agree with that. I think there's going to be a lot of, kind of the founder owned and ran businesses where it's somebody who's owned the business for 30 years. They were contemplating selling. This happened. They just went through a nightmare and now they don't want to have to do it anymore. They're kind of burned out. So I think that situation will be appearing quite a bit. And then, just in general, deal activity, because of some of the opportunity out there, I think will increase. Some of the companies that were struggling, but are still around, maybe it's good opportunity for, again, a roll-up or strategic acquisition. So I'm pretty bullish on that deluge where, probably more on the private equity side and like lower to middle market, I would say.
Yeah. On those same lines, I think we're going to start to see, when do you think we'll start to see a resumption of more traditional deal activity? I think it's going to come in stages. I feel like it's going to come in as the economy comes in and out, and we're seeing that with states starting to pull back and shut back down again, which, a lot of people predicted this anyway. And I agree with you, by the way. It's not a second wave. I think we're still just riding the first wave of the pandemic, personally.
Yeah. I think it's absolutely, that's kind of a fundamental question where if there's a little bit more comfort in the known versus discomfort in the unknown, this is new. And I think what's causing some folks to pull back is just not knowing what's going to happen. Once we have a plan, no matter how painful it is, at least then we can act on it. So I think once that's a little bit more locked down, we kind of really understand some more of the data and the science behind what's going on, if we can get real numbers, then at least, again, we have that plan and investors can kind of steer their ship around the known buoys as opposed to not being sure if an iceberg is going to pop up in front of them in 6 weeks.
Yeah, for sure. We were talking, we were talking to a lawyer, and he was talking about additional legal language that's going into the contracts now.
Yeah.
Can you shed light on that? He gave me the place where it was. It's something where there's really never been any teeth or emphasis, and now there's starting to be teeth and emphasis put in this part of the contract.
Yeah. I mean, I think reps and warranties is something that's having a lot of attention paid to it again. It always was, but really now because of just uncertainty of numbers. So what we've been seeing is investors really trying to kind of continue to protect themselves with that uncertainty. So to take some of that risk out. As far as, like structure of deals, beginning to see a little bit more of the tightening of the ship as far as like protecting provisions, redemption rights, things like that, really protecting on the downside of the deal. So yeah, they're tightening up. There's a little bit more language in the term sheets that we're seeing. I haven't seen anything too crazy that really threw us off yet, but I think there's a lot more attention being paid, and lawyers are certainly earning their their robust hourly rates, both
Right.
with red lines and suggestions.
Absolutely. Is reps and warranties insurance actually going to cover a COVID-related downturn? I mean, that seems like it's probably outside the pale, and I know that you can
Yeah.
buy insurance to, to work around some reps and warranties. I'm wondering what kind of insurance policies that you've seen or that may be out there that could be applicable that can help with the downside risk.
Well, yeah, I haven't seen too much from insurance from, say, operating downside or environment downside or even economic downside. I think the focus with the reps and warranties is to make sure, again, that the numbers experienced during COVID were not miscommunicated or misrepresented, or different things, not just the revenue, but other aspects that investors are going to go through in diligence has been accurately represented, because there's just so much fluctuation and noise right now. So I think what's caused that is probably some groups that have tried to get around poor performance or employees leaving or having to lay them off by maybe being less than truthful. So that's why that the reps and warranties is becoming, again, kind of a main focus.
Yeah, that makes sense. Are you seeing a lengthening during the due diligence and the deal process? I mean, have you seen it stretched out a little bit, or what's your thought process on that?
Yeah. So we are seeing 60 days become a little bit more of the norm. We typically would push for 30 to 45 and really get uncomfortable closer to the 60 days. That's just kind of a personal preference and something we do as a firm. But 60 days on exclusivity is something that really has to be, it's almost a necessity now, and everything that I'm seeing and some of the investors I'm talking to will not do less. They just want the time, to see what's going to happen. And it seems like a little bit more of, the diligence process right now, post-term sheet, is not just checking the boxes on legal and, org structure and operating agreement, as much as also now observing companies' performance, observing sales and bookings, but also trying to see what the market's going to do. So that's, they're kind of buying a little bit more time. I'm not thrilled with it, but it does seem to be a necessity now, and just something you need to be aware of and kind of manage through those 2 months.
Absolutely. I know at our Elevate conference, the end of May, we had 3 economists that sat on a panel, and each one of them had a different take on the recovery, the process, the timing, and so, when you've got that big of a discrepancy amongst seasoned professionals, and all of those guys had been around the block for a while, and they know what they're doing and what they're talking about, and to see that big of just difference in thought was crazy. So I could definitely see an investor trying to figure out any way possible to sit back on the sidelines and just try to understand, where this ball's bouncing and when's the best time to pick it back up.
Yeah. So
pretty interesting. I'm kind of looking through our notes. I know we're getting short on time. I haven't seen any other questions come up. And I'm looking through the notes we put together for this. You think the buyers are getting better opportunities? You think that I always feel like there's opportunities that are created in a downturn for sure, and it's there's studies out there that more people are become millionaires in a downturn than during times of prosperity. What's your thoughts on that?
I think value buyers and private equity groups are probably frothing at the mouth, because there's going to be a lot of companies that are struggling, a lot of founders that no longer want to run their business. And yeah, it could be a great time to go acquire a business if there's kind of a go forward, either value improvement or some kind of operating plan. As far as the earlier stage VC groups, again, I just keep coming back to throttling down on volume a little bit and really, really upping their bar for deal quality. And I think it's largely because, there's not as many deals right now. So there is some competition from the investor side, but people aren't trying to buy their way into companies anymore. They really want that great deal. And for those great deals right now, they are willing to pay the premium. I think that's also because they will do less, but they still want to put about as much capital into the markets. So, again, if you're out looking for a business like a flooring company, for example, that's been struggling through COVID or something like that, you can certainly acquire some really interesting assets right now with a little bit of a discount.
Absolutely. I don't see any other questions. Do you have any closing comments you want to put out there, Keenan? This has been great for me. I've learned a lot. I really appreciate your time. It's been fantastic.
Yeah. Thanks again for having me here. If you want to get in touch, feel free to reach out. That email right there is my email. Chris Badger runs now CFO Salt Lake as well. So reach out to anybody at their office. Would love to chat. I'm on LinkedIn. Thanks everybody for joining. Hopefully it was helpful, and looking forward to hearing from you and seeing what kind of companies and capital raises are out there.
Absolutely. Feel free to reach out to us, and we'll do the best we can to get you guys helped out. With that, everybody have a great day. I'm going to go enjoy a late lunch, and everybody else have a great day wherever you are. Thank you, Keenan, again. Appreciate it.
Thanks.